So this was a little lengthy to write on Instagram or Twitter, so I had to make a video. So we're going to create a budget for ourselves today and do some kind of basic financial planning. Of course, there's a lot that financial planning involves, so we won't be able to cover everything today, but we'll do the basics right. So in order to create a budget, there are certain things you need to do. First of all, you need to have a pen and paper with you, or a laptop or an iPad, wherein you can note stuff down. There'll be a lot of things that you would need to write and calculate. So get a pen and paper or a laptop or an iPad with you. Okay, to start with, firstly, we note down the inflows that we have, which means our salaries or any other additional income. This is all the cash inflow that we have. Next, we go on to the outflows, which are nothing but your expenses. So your expenses are basically divided into three categories. The first one is your necessities. This includes things like your rent or an EMI or something like local traveling. These are things which you have to spend money on, come what may. If you're an outstation guy or girl, you may also have something like food given here or bills that you need to pay. So these are your necessities. Make a list of all the necessities. Now you'll have to sit with your bank account statement and your credit card statements to figure all of this out. It's a one-time activity, a little tedious, may take a couple of hours, but like I said, it's one time. Once you get this done, you'll have your plan in place. So yeah, the first part is the necessities. Second is your other expenses, or which we may call luxuries. This includes things like eating out, parties, or say vacations, or basically anything that is not a compulsion to do. It's something that you can live without. So all the other expenses, all your expenses apart from the necessities, come into this segment. Uh, these are your two basic expenses. After this, what you have left is your savings or your investments. You may be doing some kind of investments now. So if you are, great, you can make a note of that too. Or if you have any money that is left behind every month in your savings account, you can make a note of that. We'll discuss how to make more investments in the video. But to start with, you will need to have these three things in place. Make a note of all of your necessary expenses are going to be more or less same every month. There may be a 10-15% deviation month on month, but more or less it's going to be the same. Whereas your luxuries will vary. In a particular month, you may buy something like an iPad. In another month, you may probably go for a vacation. In a third month, you may not spend too much on luxuries. So, luxury spending is going to vary month on month, while your necessities are going to remain the same. So, write down the figure of your necessities as is, and for your luxuries, just take an average over 3 months. There may be some kinds of outliers, some major expenses which you have done in a particular month. Do incorporate that, but also keep it written down separately somewhere. We'll use that later for our financial planning. Now, once you have your necessities and your luxuries written down, you need to add them up and subtract it from all your inflows to understand how much money you have left for investments or for savings. Bare minimum, at least 20 to 25% of your total money inflows should go into your investments. If you're not able to save that much, then either your expenses are really high or your salary is really low. You got to change either one of them. But bare minimum, I'm repeating this again, at least 20 to 25% of your total income should go into investments. Now, let us start with investments, which I said should be at least 20 to 25% of your total income. Investment will typically be based on your goals, and your goals can be of two types again. One would be long term goal, the other would be a short term goal. Your long term goal is something like buying a property or kids' education, things which are to be done after 5 to 7 to 10 years. Whereas a short term goal is something that needs to be done in, say, 6 months or 1 year or 2 years at the most, which would be something like buying a car, buying a bike, or a vacation. There are hundreds of instruments, your bank fixed deposits, your LIC schemes, your post office deposits, your mutual funds, you have gold investments, shares, bonds, multiple. Today I'm going to talk about two such investments. One is a risk free instrument, which is a recurring deposit with a bank. The other is a slightly riskier instrument, which is a mutual fund. Now, depending on your goal, you should choose either a risk free or a slightly riskier instrument. For short term goals, I'd advise you to go in for a risk free instrument because in the next 1 year or 2 years, a mutual fund may not give you the kind of returns that you're expecting. So, we all know what a fixed deposit or a recurring deposit is. Let's talk about a recurring deposit because we're looking at savings on a monthly basis. A recurring deposit is wherein you deposit a particular amount with the bank every month, and after a fixed tenure, say 1 year, 2 years, 5 years, or 10 years, you get your maturity amount with your interest. The interest rate ranges from anywhere between 6.5% to 8.5%, depending on the bank. Policybazaar.com gives a very good comparison of different rates offered by different banks. I will post the link in the description. You can see there are banks that offer an interest rate of as high as 9%. Again, these are smaller banks, so the risk component is slightly more compared to a bank like ICICI or HDFC. So that is a recurring deposit. Let's come to a mutual fund now. A mutual fund is a slightly detailed concept, so we may not be able to explore everything right now. But to give you a gist of it, it's an instrument managed by an individual who is called a fund manager, where multiple people contribute certain sums towards the fund, and the fund manager, the individual, takes all the money from the people and invests it in other instruments like stocks, bonds, or debt. Now, depending on where that money is invested by the fund manager, the returns can be high or low. If invested in equity and the market is doing well, the returns can be very high for the entire fund, which means the individual who has contributed to the fund will also get a proportionately higher return. Whereas if it is invested in something like debt, the returns would be a little lower but would be safer compared to equity. So, say the fund manager invests 500 crore rupees, which he has collected from multiple people. Those 500 crores give him a return of, say, 15%. He may keep a couple of basis points or percentages with him and then distribute the remaining among the people. Somebody who's invested 1000 rupees in that mutual fund may get 1015 rupees. So, I've just given a brief of what a recurring deposit and a mutual fund does here. You can probably screenshot it and have a look at it later. Now, coming to the main concept in a mutual fund for a monthly saving, it's called an SIP, which is a systematic investment plan. As the name suggests, this plan enables you to systematically invest money every month in a mutual fund. So, say you have 1,000 rupees every month which you want to invest. Every month, 1,000 rupees gets debited from your bank account and goes into the corpus of the mutual fund. So in a year, you're investing 12,000 rupees. In 5 years, you're investing 60,000 rupees. 10 years, you're investing 1,20,000 rupees. Now, depending on when you have invested and when you withdraw the money, you get certain interest on the amount that you invested. So SIP works great for people who are salaried, who have a fixed income every month and can keep a portion of that aside for investments. If invested well and if invested in a good fund, SIPs can give you great returns of more than 12 to 13%, whereas you can see that banks will only give you about 7 to 8% at the most. So, an SIP is something that every individual must do. For people who are less than 40 years of age, they have the capacity to take the risk. So, mutual funds are something that should be invested in for young investors. However, mutual funds take some time to show the appreciation. So if you are going in for a short-term goal, do not invest in mutual funds. However, for a long-term goal of 5 years or more, the stock market has 99 out of 100 times given good returns. So it's a risk worth taking. Well, we may be seeming to have digressed from the topic, but we've not. Uh, these two instruments are very important for us to understand so that we can budget and plan our finances accordingly. So now that we know that an RD is the best form of investment for a short-term goal, and a mutual fund is the best form of investment for a young person from the long-term perspective, let's come back to our budgeting exercise. So let's consider somebody who has a salary of 20,000 rupees. He breaks it down and analyzes it for his expenses. So his necessities are about 10,000 rupees. His luxuries are about 5,000 rupees. Now, out of 20,000, he's got 5,000 rupees every month, which is spare, which is in his savings account. How do we budget his monthly salary so that he can make good investments? Let's say this guy wants to purchase a two-wheeler at the end of 2 years. That's his short-term goal. He wants to have a corpus for his child's education after say 10 years. So let's list it down. Short-term goal is a two-wheeler in 2 years. Long-term is child's education in 12 years. There are various websites which will show you the returns on your investment. For example, if you want to know the returns on your recurring deposit, you can go into any bank's website and they have an RD calculator. Let's take ICICI Bank. So say the guy invests 2,000 a month for 2 years at 6.3% per annum. You can see that his total savings are 51,000, of which he has earned an interest of 3,263 rupees, which is good enough for a two-wheeler. So here we say is 2,000 per month. Now there are also websites to calculate returns on an SIP. SIPcalculator.in is one such website. So I've keyed in 2000 rupees for 12 years. An expected annual return would be about 11 to 13% if invested in a good fund. So let's take 12%. See that 2000 rupees invested every month for a period of 12 years at a 12% expected rate of return will give this guy around 6.5 lakh rupees, which would be good enough to start with his child's education. So rupees 2000 per month. And of course, 1000 rupees in his savings account would be kept in the savings account itself for a rainy day. Just a disclaimer, these numbers are just taken randomly. I've just picked a salary of 20,000, considered his expenses to be 15,000, just to give you an idea of how you can plan your investments and your savings accordingly. Now, an important factor to consider is the fact that your income is not the same every year. It keeps increasing, so should your savings and your investments as far as possible. I'll also quickly in a minute cover tax saving here since this is the financial year end. While there are multiple sections under which people can claim a tax rebate, the most important section is section 80C, which deals with investments. So according to government regulations, under section 80C, there are certain investment instruments wherein whatever amount you invest can be claimed as a tax rebate. This section has a maximum cap of rupees 1,50,000, which means if your net taxable salary is 3 lakh rupees after all the other deductions, if you have an ATC investment in any of the instruments for 1.5 lakh rupees, your net taxable salary would come down from 3 lakh rupees to 1.5 lakh rupees. So you would not have to pay any tax on the 1.5 lakhs that you are investing in section 80C. I'm sure most of us would be doing these investments, but I'll just give a brief of ELSS, which stands for Equity Linked Savings Scheme. These are again mutual fund products where you can invest and claim tax rebate under section 80C. So I can invest in an ELSS mutual fund and my net taxable salary will come down by the amount that I have invested in this ELSS fund. So suppose I'm investing about 13,000 as an SIP on a monthly basis in this ELSS fund. After a year, I will have invested 1,56,000 rupees in this mutual fund, which means my tax liability is now 1.5 lakh rupees less than what it was if I would not have invested in this fund. Again, if you don't want to go in for the risky investments, you can opt in for an LIC or a provident fund. But an ELSS gives you a good way to not just save tax but also get good returns. One more important thing to note is that you should have at least 3 months of your expenses in a liquid account. By liquid, I mean this should be in an account or an instrument from where you can withdraw within one day. This can be a fixed deposit, it can be a savings account, it can be a recurring deposit, or any other instrument which will not penalize you for withdrawing the money. So, depending on the bank, they charge a small fee if you tend to foreclose your FD or your RD account. But that's, like I said, a nominal fee. So, this is a kind of a liquid instrument where you can invest. Secondly, whenever you're investing, keep in mind the inflation rate. If the inflation rate is 6% and you're getting an interest of 6.5% on your recurring deposit, it makes no sense. You'd rather invest in a bank which is giving you at least an 8.5%, or you go in for riskier instruments. So whenever you're investing, keep the inflation rate in mind. Be prudent while selecting savings accounts. While Axis Bank would give you 3.5 to 4% interest on your savings account, Kotak 811 gives you 6%. While ICICI gives you 6.3% on your RDs, an RBL or an IndusInd Bank may give you anywhere upwards of 8%. So do your research. Check out all the bank websites, compare the rates, and only then take an informed decision. Now, the last point, how do you ensure that you are having 25% of your total income as your investment? If you remember the outlier expenses that we had spoken about in the beginning, that 25,000 you spent on your iPad or the 20,000 you spent on the smartwatch, avoid those expenses. If you're able to achieve 25% with those expenses, nothing like it, but try and aim for more. Like I said, bare minimum is about 20 to 25%. If you're not able to reach that, cut down on those outlier expenses. This is very important. Well, guys, so that's about it. Please go through the audio and the video and let me know what you think about it. In case you have any questions, you can always reach out to me. Thank you.